All right, thank you everyone for joining us today. We're going to go ahead and kind of run through some housekeeping items and get started, and there'll be more folks joining us here, I'm sure, in the next few minutes. So thank you for joining. We have a Farm Bill panel today entitled Midwest Voices, and we're very excited to hear from folks very much impacted by the Farm Bill, and especially out here in the Midwest. So first, introduce myself. I'm Sheila Korth. I'm a policy analyst at Taxpayers for Common Sense. I work from home in Omaha, Nebraska, and I'm from Nebraska, but Taxpayers for Common Sense is based in Washington, D.C. I also have my colleague joining here today, Josh Sewell, who is going to be helping out, and some of you may know Josh as well. If you have any questions today, please feel free to put those in the chat and we'll try to get to those at the end. We can also follow up over email. Many of you should have my email address. And if not, we can put that in the chat as well. We'd ask that everybody just stay on mute, please. And it looks like everyone's already doing that. So thank you so much. We have 4 wonderful panelists with us today. I'll introduce them in just a little bit. And just as a note, we're going to try to focus today on the commodity, crop insurance, and conservation titles of the Farm Bill. Obviously, there's a lot more to the Farm Bill than just those 3 titles, but we'll focus our time on those today. And we'll try to discuss how those subsidy programs interact with conservation, how they impact beginning farmers and rural communities, and other facets of the farm safety net programs. We'll also probably touch on which reforms are being considered on Capitol Hill right now, with the Farm Bill being up for reauthorization this year. There was a 1-year extension that was passed last year, and so the current Farm Bill extension will go through September of this year. I will give a very short overview of what the Farm Bill is, and obviously most of us know there's much, much more to the Farm Bill than this, but overall, it is a bill that is expected to cost taxpayers around $1.3 trillion over 10 years. And when we say that, we're referring to the 2018 Farm Bill. We have a lot more resources on our website, including a Farm Bill 101, and we have a 2-pager on crop insurance and many other resources. So that can be found at taxpayer.net, and we can follow up with some more resources afterward as well. When we're talking about Farm Bill spending, most of Farm Bill spending goes toward nutrition programs and the Supplemental Nutrition Assistance Program, which encompasses about 80 to 85% of Farm Bill spending. But today we're going to be focusing on the rest of that spending. So when you're looking at the crop insurance program and commodity subsidies together, which we will refer to generally as farm subsidies, when you take out the nutrition spending in the Farm Bill, for every $4, roughly 3 of those dollars are going to farm subsidy programs, and the other $1 is going toward conservation programs. And saying that, I think as most of us know, there's been a lot of additional spending that's come through the U.S. Department of Agriculture in recent years. We're not going to focus as much on that today, although I'm sure it will still come up from the panelists and maybe in the Q&A. That additional spending that came outside the Farm Bill includes payments for things like COVID-19, for trade payments, payments flowing through the Commodity Credit Corporation, and a lot of other spending. I'll mention just a few things about the crop insurance program and some of the commodity subsidies. I won't go into a ton of detail. Some of our other panelists are going to do that. But overall, the federal crop insurance program has become one of the most expensive farm safety net programs in recent years. The Congressional Budget Office now expects the federal crop insurance program to cost taxpayers around $12 billion each year. That program provides subsidies for both private insurance companies and agricultural producers, and provides subsidies for those producers to purchase crop insurance. There are around 140 different crops that are eligible for crop insurance, but most of the subsidies, both within crop insurance and commodity subsidies, flow to around 5 crops. And those include corn, soybeans, wheat, peanuts, cotton, and rice. The one important point about crop insurance subsidies is that they're non-transparent to taxpayers, and they are currently unlimited. So the Government Accountability Office has found that these subsidies flow to people with net worth in the billions and millions of dollars. Shifting a little bit to the commodity subsidies, these are expected to cost taxpayers around $4 billion each year. And there's two general programs within the commodity title of the Farm Bill. Those include ARC and PLC, the Agriculture Risk Coverage Program, and the Price Loss Coverage Program, the latter one, which is known as reference prices in the Farm Bill debate right now. I won't go into a ton of detail on those, but we can send some more information later about those subsidy programs. The final thing, the goal of today is to talk about whether some of these Farm Bill programs are achieving their goals, some of the impacts that they're having on the ground, and what common sense reforms can be implemented in this Farm Bill in particular. Finally, before I introduce our panelists, I just would like to say that I won't go into a lot of Farm Bill history. Hopefully, John can cover some of that. But to note that some of the proposals and things that may be discussed today have been introduced in past Farm Bills as amendments or policy proposals. And so they're very relevant to the discussion today. Some of those proposals have been things like closing farm subsidy loopholes introduced by Senator Grassley, for instance, or folks who have, or proposals to ensure that millionaires are not receiving farm subsidies, for instance, and then also on the crop insurance side to start to pare down some of those unlimited subsidies. And various members of Congress have introduced proposals on that as well. Just a few include Representative Blumenauer and Senator Shaheen in the Senate. I will stop talking because we're here to hear from our panelists. So I'm just going to give a quick introduction, and all of you feel free to jump in or correct me if I got anything wrong. Today, we'll first hear from John Campbell. John is a former undersecretary at the U.S. Department of Agriculture. John worked on Capitol Hill on farm bills and has a lot of expertise. John also is from Nebraska and has experience ranching and farming in Nebraska and Wyoming. Then we'll hear from Dr. Cory Walters. Cory is an associate professor at the University of Nebraska-Lincoln in the Department of Ag Economics. And Cory has written a great paper on crop insurance subsidies and the impacts on farm consolidation and on rural communities. Cory is from a farm in Montana, and very glad to have his expertise here today as well. Then we're going to hear from two farmers. The first is Scott Kinkaid in Northeast Nebraska. Scott farms with his son on a multi-generation farm and has tried everything from hops to cover crops and has farmed no-till for many, many years. And then we'll hear from Wendy Johnson of Iowa. Thanks, Wendy, for joining the Nebraskans here today. Wendy is the owner of Joya Food Farm in Iowa and has sheep, chickens, pigs, and cattle, and very excited to hear about how Wendy has increased wildlife habitat and implemented conservation practices on her farm. So with that, John, I'll turn it over to you. Thank you.
Thank you, Sheila, and thanks everyone for joining this morning. Sheila asked me to give me a brief history of farm programs, and I will keep it brief. Basically, from 1933 until 1996, farm policy was aimed primarily at dealing with chronic surpluses, farmers always producing too much, prices being too low. And the main tools that were used during this period were supply controls, acreage allotments, farmer-owned reserves, and policies like that. I'm going to kind of focus starting in 1980 because there's eerie similarities today to 1980. And if you're watching what's going on in Europe with the farm protests, that's what Washington looked like in the late 1970s, early 1980s. Farmers forcibly occupied the Department of Agriculture. They drove their tractors to Washington, tied up traffic, parked on the mall, maybe things that have been forgotten. But it was an inflationary period, and farmers were caught in a cost price squeeze. We had a Russian grain embargo. We had high interest rates. And this period was immediately preceded by the 1970s, where we had rapid land inflation and everybody felt rather wealthy, although there were a lot of debt against land. So we kind of have a similar situation today, although not nearly as severe. Farm debt levels are not nearly as high as they were in the 70s. But we do have an inflationary period, and farmers are now looking at their second year of cost price squeeze and lower incomes. So in 1980, Congress increased price supports and loan rates and target prices in an environment where the world was going the other direction, and this kind of caused a train wreck of sorts. We had to idle 79 million acres of land in 1983 to try to match the supply-demand imbalance. So in 1985 and 1990, those bills leaned towards more market orientation. We got marketing loans for most commodities between those two bills, and that let prices, drift to market clearing levels. But we also implemented a 45 million acre conservation reserve program. So it wasn't until 1996, when we got the Freedom to Farm bill, that production was decoupled from price and income supports. In other words, the farm programs weren't driving farmer planting decisions, and they weren't interfering so much with the markets. Farm bills since then have expanded the role of subsidized crop insurance, as Sheila mentioned, and also improved the income stabilization aspects of farm policy by considering not only yields, but prices. So in summary, the last 40 years have seen an evolution towards more market orientation and program efficiency, and basically farm programs have been greatly reformed in that respect. And again, we're talking about the Title I programs, the price and income supports, and the crop insurance. And these are all entitlement programs, meaning there isn't other than very modest income limits and payment limits. They're basically entitlement programs. If you qualify, you get the money, and the more you produce, the more you get. But when it comes to other policies, such as conservation, the track record is not as good. The CRP was established to control wheat supplies, primarily in the High Plains, and much of that original land that was put in the CRP almost 40 years ago is still in the CRP. Efforts have been made over the years to modernize the CRP and better target it, but because of acreage caps and budget caps, those efforts have not been as effective as we would have hoped. So there's a plethora of other discretionary conservation programs that are not CRP, but they are underfunded and oversubscribed. There's always more farmers wanting to use these programs than there is money to put on the ground. And these are not entitlement programs, but they're subject to annual appropriation bills and annual budgetary discussions. And as Sheila said, the commodity programs are 75% of the spending in the ag portion of the Farm Bill, and they really drive farmer behavior. So the conservation programs kind of try to offset the incentives for production that come from the other programs, but they simply are overwhelmed. There's no way the conservation programs can offset the incentives for production in the commodity programs. So we have a situation in rural America, much of rural America, where you can't drink the water, you can't swim in the lakes, and you can't eat the fish. And a lot of this has to do with residual effects from agricultural production, mainly nitrogen, phosphorus, pesticides, and herbicides. And the farm programs not only do not address these issues, but they tend to make them worse. So ironically, we have the Inflation Reduction Act, which may have more potential to incentivize better farming practices than all the farm bills put together. And by that, I mean the rules have not been written, but there is the outline for a biofuels tax incentive program based on the carbon score of the fuel, including the on-farm score is envisioned. So we've heard a lot about regenerative agriculture, climate smart agriculture, and there's nascent activities in the marketplace to make these programs more abundant, but the Inflation Reduction Act actually has the potential to make it happen on a landscape level, meaning millions and millions of acres. So not to take away from the farm programs, but the Inflation Reduction Act through the biofuels program has the potential to really turbocharge the adoption of regenerative farm practices and the reduction of carbon scores on the farm. So Sheila, with that, I think I'll turn it back over to you.
Thank you so much, John. You did a fantastic job of giving Farm Bill history in a very short period of time and bringing it to the present. So thank you so much. Cory, we'll turn it over to you now to talk about a little bit more about crop insurance. Thank you so much.
Thank you, Sheila. Thank you for everyone attending. And John, that was a great reminder. I remember my dad talking often about the wheat embargo up in Montana and how detrimental that was to the markets. A little bit about myself, a little disclosure. I am not on retainer for any AIP. I don't have any private companies that does business with the RMA. I am an academic that is from the farm that is interested in crop insurance. I started out learning about it when I was at Montana State, when the farm was going through a real tough patch in financial viability. And so I've stayed clean of all these other competing interests for what I have to say. Crop insurance. What do I think of it? I find it to be the largest technological advancement in risk management in the past 30, 40 plus years. It is a gigantic game changer for farmers and how they proceed into the future. What it does, it rearranges your financial outcomes. When you're not purchasing insurance or you're self-insured, you're going to have a wide range. You're going to have some low yields, low prices, or high yields, high prices. And when you buy insurance, you're just lopping off that tail, and you get to operate in this environment where you don't have to suffer through low yields and low prices. And that gives a gigantic strategic advantage to people that understand the environment at which they're facing. So let's get into a little more on crop insurance. It is wildly different, especially back 30 years ago, than the FSA programs, where it offers a menu of contracts. You can select what you want. There are hundreds of different combinations of contracts you can select, but in reality, farmers typically focus in, especially in the Midwest, on a few certain ones are the place. Participation is also voluntary, and it costs money to participate. You will pay a premium, so you put some skin in the game in there. So because of that, there is some self-insurance. There are people that still don't buy insurance, especially back around 2000 is where I'm thinking with the ARPA Act. That was the last major change on subsidies. Then you had in the 08, you also had the enterprise unit one. So let's get into the paper. This came out of experiences I've had, experiences I've talked with farmers about, and just understanding how do you conceptualize the role of insurance in your net income distribution. How do you use that to your advantage to strategically behave into the future? And at the same time, man, policy design is tough. Don't get me wrong here. I am an advocate for crop insurance. The subsidy side of it is, there's a lot of pressures on that side, but policy design is tough. So then there are unintended consequences. And so what we found is subsidies exist to encourage participation. And this is a very short run thing. We get to start and stop it every year. So there's subsidies sitting here for this upcoming year. We have a few weeks for our spring crops here in Nebraska to decide what contract we'll have, and there'll be subsidies associated with that. But me as a farmer or any farmer, they exist also to think about the long run. What's going to happen over the next 2, 3, 4, 5, 10 years? And a lot of farmers exist in that area, in some part of their mind to think about, you know, how do I position myself so I can survive? You don't often talk to a farmer and not hear that they are the 3rd, 4th, 5th generation farmer. So there's a sense of survival. So in the long run, what crop insurance premium subsidies do, and for some part, you can also say A&O and all the other stuff because it lowers the cost to participants. It increases the return over time to where when you put $1 in of your own premium, you're going to get more than $1 back because you're not paying the fair rate of insurance. So you will get more back in time. And the only way that happens is through indemnities. You need to have payments. And the basic understanding there is you're gonna get back indemnities that you didn't pay premium for. The subsidies paid those premiums. So you're going to get that back. And of course, when that happens, you're going to learn about it. And when that happens, when you get an indemnity back, and let's suppose you have a neighbor or a group of neighbors, and go back to 2000, that were not participating in insurance, and there was, let's say, some land up for rent or some land for sale. How do you behave knowing that you got that indemnity check, but your neighbors didn't? And you're both competing for that resource. It's pretty tough when you didn't get the indemnity check because you may be going to talk to the banker about how am I going to roll my operating note from one year to the next? Do I take out long-term land debt to pay my short-term liability? So we dug into this, viewing through the long term, and what we found is that those premium subsidies have led to consolidation in fewer and larger farms to some degree. Now, this is an ongoing process. We haven't found the end all. It's tough. It's tough to tease these things out, but there appears to be a relationship. And if you know anyone that went through, let's say, the 2012 drought and they didn't have insurance, and then to someone that did, you just take a look at their balance sheets at the end of the year. It's staggeringly different between those things. So what can we do about it? Education is absolutely paramount in this. We have to educate farmers what insurance does so they have the proper view of how to behave in it. You know, the subsidy is that's a policy lever that can be moved around, and there's plenty of really intriguing ways that you can move that premium subsidy around. And I've actually published another paper on that guy. There's a lot of possibilities in there. What's next? When there's consolidation, then the next part is natural question is what's the incidence of those subsidies ending up in land values? Because now in 2024, the participation rates are much higher. We're above 90% or right around there for corn and soybeans in Nebraska. So everyone's participating in insurance. Although some may have a low coverage level, some may have a really high coverage level. There could be differences in payouts there. But how has insurance then contributed to farmers understanding what's they're facing in that different distribution that they're sampling from with insurance, and how are they then competing for those resources? The question then is it now, have they put that money into land value, making it more difficult for people that don't understand the system to continue to compete for that? Because we hear a lot of statements like, I don't understand anyone can pay for that. I think there's a lot of really smart farmers out there that are starting to really figure it out of how insurance has revolutionized the forward-looking view of dealing with uncertainty. And with Sheila, I will stop there, and looking forward to hearing from Scott.
Absolutely. It's going to be a great lead into what Scott, I'm guessing, has to say. Thank you. And I just wanted to mention for folks who aren't as familiar with what A&O subsidies are, they're administrative and operating subsidies, which are in the crop insurance program. So when I mentioned that the crop insurance program has two main buckets of subsidies, one goes to the farmers and premium subsidies, the other one goes to A&O subsidies for private insurance companies and their agents. And so both of those two pieces have increased in costs over the last several years. And we can send some more detail about exactly where those costs are landing now and where they're projected to be over the next 10 years. But they're very significant. And the Government Accountability Office recently put out a report in November last year that has some more details on those subsidies and how large they are for some individual crop insurance agents. For instance, some individual crop insurance agents are receiving $1 million a year to write one crop insurance policy. And there's some other, from our perspective, staggering statistics in there. And just wanted to mention too, on the portion, Cory mentioned that the taxpayers cover a portion of the crop insurance premium. It's roughly 60% that taxpayers are subsidizing, and the farmer is roughly on average contributing 40%. That does differ by if you're a beginning farmer or not, and some other
yeah, it can range from 80% with enterprise units down to 38% with optional units and high coverage level.
Perfect, thank you. So I just
and I put the paper in the chat.
Thank you so much. So that's the paper that Cory wrote. Thank you. Thank you so much for your expertise and for digging into this. It's great to have data to point to. And I think the lead in for Scott will be great. So Scott, take it over. Thank you.
Well, thank you for giving me this opportunity. I wish I was a better speaker and could better communicate my thoughts. I often I have a lot in my head, and when it comes to saying it, I forget it, some of it, and kind of confuse things sometimes. But I'll do the best I can. I want to start with a couple of things that Cory mentioned. One thing he said, insurance is voluntary, which it is, but it isn't, because if I'm borrowing money when I go to the loan, when I get an operating loan, there's a number of papers that I got to sign, and one of those papers says that I'm going to buy crop insurance or I don't get the loan. So yes, it's voluntary, but it really isn't voluntary, and that's a big reason that there's a large percentage of people that do it, is because basically they have to. Also, they want to make it so that people do it, because with more participation, that's basically more control. Anytime the government sticks their hand into something, it tips the scales, whether you like it or not, whether it's the direction they wanted it to go or not. It tips the scales, and it affects more things than you realize. And I'm convinced that these, and have been for some time, have argued against government subsidies of any kind, whether it's through crop insurance or direct payments, because in the end, that money ends up in a pocket of the landowner every time. And that makes it tougher for younger farmers. So that affects rural America as a whole. It means fewer schools, fewer hardware stores, fewer lumber yards, fewer towns, less vibrant economy. And I'm wondering, is that really what we want to do? And I don't think it is, but I think that's the result. And I really saw it with that freedom to farm when that started. I saw the greed in landowners. I had a landlord that I'd been renting land from, I think for 2 years prior to that. Each year had a 1-year lease, and the next year did again another 1-year lease. The third year he wanted a 3-year lease, so we negotiated and agreed, signed a paper. And it wasn't very long after that they come out with this freedom to farm thing. And he stopped me one day on the road, thought, oh, we need to renegotiate that lease. I didn't know the government was going to do that. And I said, well, I didn't either. So he had a whole new lease written up and signed for me to sign, which I essentially took home and used as toilet paper. I thought we negotiated this and we signed it, and I stuck to it. But he wanted more money right there, because the government's handing out this money. He wanted his share, and eventually he got it when that lease ran out. He got it then, because I quit farming it. I didn't want to deal with the guy anymore. But the next guy was willing to pay the extra money that he wanted, and life goes on. So, well, now I kind of try to remember one thing he said, mentioned that sometimes farmers don't understand. And that's true. It's a complicated, crop insurance is complicated. There's a lot to understand, but a lot of times it's not that they don't understand, it's because the subsidies as they are, they benefit the larger farmers to the detriment of the younger guys. And it's not about that they don't understand it, they just don't get as much money to deal with. If you're, you know, we're competing with our neighbors when it comes to renting land, that kind of thing. Everybody wants to grow their operation. So you're competing with them. So like a friend of mine said, if you think of the money that the government is putting out here as bullets, and I get 5 bullets, but my neighbor gets 40 bullets, who's going to win that battle? Not me. So the younger guy is at a disadvantage to the guy that's getting 100 bullets and he's getting 5. Yeah, he got 5 and he thinks that's great, but not when the other guy is getting several times more than he is. It puts him at a disadvantage. There's no benefit in my mind from any farm payments of any kind when it comes to young beginning farmers, unless they can direct it right to them. A lot of times they start out with that intention, but big money interest can get in there and change everything around to where it doesn't end up being that in the end. So that's the basis of what I have to say. It's always been what I've said. I've talked to you in the past. I think you've heard it before. So
Thank you, Scott. Really appreciate your perspective. And Scott, as I mentioned, farms with his son. And I know there's a lot of heart there when it comes to multi-generation farming. So thank you so much, Scott, for joining us. Wendy, we're going to turn it over to you. And I think you can take up as much time as you want. Thank you.
All right, that's great. Thank you. And thanks, Scott, for your thoughts as well, John and Cory. I'm going to tag on to a lot of the things that you've already said. I do want to first preface that I am a 4th generation farmer here in Northeast Iowa, and I have a foot in a few different worlds. One is I'm a commodity farmer as well as an organic farmer and grazer, and I have seen our weather impacts both on our commodity farm, as well as I observe and see how weather has been impacting our diversified farm, which is what I consider more resilient. So I wrote some of my thoughts down because I don't have I have a short amount of time to get them all in. So so I'm going to start right in there. So I think, as you all know, and I'm not saying this is nothing against Nebraska, but I do think Iowa has some of the richest soils in the world. I'm sure Nebraska, Missouri, Minnesota, Wisconsin, the upper Midwest has some of the richest soils in the world. So some of the richest soils, I think, that need to be protected the most. And but I've seen over the winter time, specifically when the snow melts and the snow is starting to melt, I see a lot of soil movement across. Our snow turns gray pretty quickly, and so there's a lot of soil that's being washed and blown away due to some of these intensive industrial systems, such as monocropping of a lot of corn and soybeans here in the upper Midwest. And so we're seeing these stronger wind and rain events due to I think our changing climate, and I think we're losing. Actually, it's proven we're losing soil faster than even at the height of the Dust Bowl. So it begs to differ. What have we improved conservation wise? What have some of these programs done to help us? And so that's a big question mark for me. So land in this region in Iowa, the value is based on how suitable it is to grow corn. The better the soil to grow corn, the higher the land costs. And so the average Iowa farmer is also around 60 years old and is a white male. And farmers in Iowa make up less than 4% of the population. But every single farmer of any type is trying to stay in the business of farming, and it's proving itself to be more difficult each year. So when you're trying to stay in the business of farming, you're trying to grow your farm business, you do what is supported. And so when we think of growth in the Corn Belt, it means buying or renting more land. And I'm going to give a brief example. There's a farm that's close by mine that I'd like to buy. It has fenced rows, hedgerow sections. It's a perfect design for grazing, adding some organic small grains. But to afford that farm and to be able to pay the bank each year because of its high corn suitability rating, I'd have to grow corn on every acre of that every year to make my payments. And so it disincentivizes me to grow anything else. Even small grains in a crop rotation, in organic crop rotation, for example, is a break-even crop, really only used to break some pest cycles. But so the infrastructure and the markets, I'm suggesting ethanol plants, feed and grain co-ops, and the big processors here. The agricultural policies, including the risk mitigating strategies and ag finance, are all in place to help keep farmers growing corn and soybeans here in the upper Midwest. It really makes things easy. You add on to that an aging farmer population, and there's little way in for farmers who want to start out. The increasing cost of land and property values due to corn, and this really competitive mindset based solely on production alone, we're on this kind of downward spiral toward a few wealthy owning all the land, who might in the end not even be farmers. So it also leads us to a lack of nutrition due to highly processed foods, non-potable drinking water, and I think potentially eventually desertification. So I believe we have a kind of a complacency problem here in the Corn Belt, and it's trickled down via policy. And this kind of what ain't broke, don't fix it mentality is really caused by the protections in place to mitigate risk. But it is what is protected that is causing the issue. The policies in place only protect a few crops. We can plant a crop of corn and soybeans here, and if it fails, we might make more than if we grew a decent crop because of crop insurance and commodity protections in our farm bill. This kind of policy and protections for only a handful of crops doesn't take into consideration a changing climate. And we're already seeing increased prices for crop insurance products due to increased risk. So, and we're also seeing increased subsidization for commodities with taxpayers' money, with this coming farm bill potentially grabbing more of that pie, pulling money away from conservation and conservation practices that are proven to mitigate and adapt to a changing climate. So what if we use some of these similar tactics to promote diversity? And here's just a few ideas. So, let's have a policy shift to value the land differently. The land is now not affordable to new farmers to access land, but we could be growing lots of different foods, different types of foods at scale here. State and federal policies that promote diversification, like subsidy reform. I know that's a bad word in some areas, but it's not just for a select number of commodities, but for local foods to our schools, our institutions, hospitals, nursing homes, company cafeterias, and policies that promote and value ecosystems and practices to conserve them. Also, federally subsidized crop insurance for all crops and livestock at similar levels, not just the select few. And flexible ag finance that understands the fluctuations of a diverse rotation and the need for integration of livestock on the land. Regenerative agriculture really requires a long game. It's a long-term investment, sometimes with slower returns, but it's a long-haul investment. So also, we need more seed research outside of corn and soybeans. We could potentially grow some competitive oats in Iowa, for example, for diversification, if there was some investment into seed genetics. And incentivize increases in gains in organic matter with methods such as multi-crop rotations and grazing livestock. And we should disincentivize practices like corn on corn on corn on corn. I have several neighbors who just grow corn all the time with no diversification. And they're some of the largest farmers with the largest equipment and the largest bin sizes. And I'm not envious of that, but I see their soil wash away and it actually ends up in my fields. So I'm kind of gaining sort of in the long term, but that's what the incentive is telling them to do. So what I think will come from this is really a diversity of crops grown. We could have diversity of jobs. We could have robust rural communities and more people on the land growing our food and fiber. We'll have cleaner water. We'll have healthier food. We'll have a sense of community again. That's really been lost with this really uber competitive mindset. We'll have a reduction in emissions and most importantly, resiliency to weather volatility. And we'll have a lot of abundance of people, abundance of food, abundance of diversity and a value of ecosystems. So I want to really end with, I think our Farm Bill needs to be preventative versus business as usual. And I think with a preventative long-term strategy, that's going to save taxpayer dollars over the long haul. Thank you.
Thank you so much, Wendy. And thanks for ending on a positive note about all the opportunities that are out there across the board. You mentioned nutrition, you mentioned opportunities for more people getting into farming and staying in farming and so many other things, keeping soil on the ground. Thank you so much. I will just ask if any of the panelists have anything else to mention that they forgot to mention or would like to comment on somebody else's presentation. And if there isn't anything, panelists, feel free to put questions in the chat and we'll try to get to them. We should have plenty of time here. Anything else for the good of the order, Cory?
Me? Did you have anything to say? No? No, I'm all good. Yeah, I appreciated Wendy's insights there, and you know, when for premium subsidies in conservation, it seems like the link is natural. I just don't know how it will evolve.
I do just want to add, you know, you mentioned the IRA earlier, Sheila, and I really think that believe that the IRA is a very, very unique. It's so unique that it finally feels like there's a recognition around conservation and taking a more preventative approach than a business as usual approach. And I know that there's talk that those IRA dollars are up for grabs. And so I just really want to ask everyone here, you know, what do you want our Farm Bill to do for you? In my opinion, I really want it to be a preventative one that's going to save us as taxpayers quite a bit of money by putting some investment in first. And that's where I think this IRA piece really is this investment piece first for a very a long-term, where we're going to see some long-term things back to us versus this very short-term business as usual that we've been accustomed to.